Welcome to our session on fraud prevention and ethical practices in the workplace. Today, we'll explore some of the most common fraudulent schemes and unethical behaviors that can jeopardize organizations. From bid rigging and conflicts of interest to billing schemes and shell companies, we'll dive into real-world scenarios and red flags that professionals need to recognize. Whether it's understanding check tampering, register schemes, or larceny, this presentation will provide you with the tools to detect, prevent, and address these challenges effectively. Let's uncover how strong internal controls, ethical vigilance, and proactive measures keep organizations safe and maintain trust in the financial and corporate world. Placing any restriction in the solicitation documents that tend to restrict competition is called pre-bid solicitation. A. True. B. False. Which of the following is the criterion for bid solicitation? A. Containing false statements. B. Allowing the purchaser to discuss possible employment with the contractor. C. To withdraw low bids. D. To falsify the bid log. Collusion or bid rigging between bidders is called A. Bribery receipt. B. Bid solicitation. C. To withdraw low bids. D. Contract acceptance. The behavior profile of employees who are involved in bribery schemes may include A. Gambling habit. B. Extravagant lifestyle. C. Drug and/or alcohol addiction. D. All of the above. Which of the following is not the example of bribery prevention policies? A. Reporting gifts. B. Discounts. C. Business meetings. D. Resource diversions. A occurs when an employee, manager or executive has an undisclosed economic or personal interest in a transaction that adversely affects the organization. A. Conflict of interest. B. Illegal sale. C. Unauthorized purchase. D. Financial disclosure. A scheme is classified as a conflict of interest. A. When an employee must have some kind of ownership or employment interest in the vendor submitting the invoice. B. When a salesman must have some kind of ownership or employment interest in the vendor submitting the sales. C. When a purchaser must have some kind of ownership or employment interest in the vendor submitting the purchase. D. When a dealer must have some kind of dealership interest in the vendor submitting the stock. The fraudster's interest lies with an employer other than a company. A. True. B. False. A special scheme in which employees know their employer is seeking to purchase a certain asset and take advantage of the situation by purchasing the asset themselves is A. Conflict of interest in sale. B. Turnaround sale or flip. C. Unauthorized sale. D. Written sale of unique assets is required if and when officers, executives or other persons in trusted positions become subjects of a criminal indictment. A. Conflict of interest. B. Turnaround sale or flip. C. Disclosure. D. Resource diversion. Which of the following method is not used to detect conflicts of interest? A. Tips and complaints. B. Review of vendor ownership files. C. Underbillings of assets. D. Interviews with purchasing personnel. Conflict of interest cases are more easily prevented than detected. A. True. B. False. Which are check tampering frauds in which an employee prepares a fraudulent check and submits it usually along with legitimate checks to an authorized maker who signs it without a proper review. A. Endorsed check scheme. B. Legitimate check scheme. C. Payable check scheme. D. Concealed check scheme. Multiple cashiers operate from a single cash drawer without separate access codes is a red flag for A. Fraudulent scheme. B. Disbursement scheme. C. Register scheme. D. Force inventory scheme. Maintain the presence of a manager or supervisor near the area of the cash register as a deterrent to theft is a prevention for A. Fraudulent statement scheme. B. Asset misappropriation scheme. C. Larceny scheme. D. Register disbursement scheme. The scheme which reduces victim companies to issue fraudulent payments for goods or services that they have not received is called A. Bogus claims. B. Billing scheme. C. Reliance billing. D. Misappropriate claims. The most common method for billing scheme is A. Register. B. Tips. C. Accident. D. None of the above. Which of the following is not the type of billing scheme? A. Invoicing via shell companies. B. Invoicing via non-accomplice companies. C. Invoicing via accomplice companies. D. Personal purchases with company funds. In underscore scheme, an employee creates false vouchers or submits false invoices to the employer. A. Sale requisition. B. Purchase requisition. C. Voucher handling. D. Cash generating. A voucher is A. A file that includes the purchase order that was sent to the vendor invoice listing the cost and quantity of items purchased, and the internal receiving reports that verify the purchased items have been delivered. B. A figure that includes the sale order that was sent to the dealer, the vendor invoice listing the cost and quantity of items sold, and the internal receiving reports that verify the purchased items have been delivered. C. A report that includes the purchase order that was sent to the vendor invoice listing the quality and quantity of items purchased, and the external receiving reports that verify the items have been sold. D. A mammogram that includes the purchase order that was sent to the purchaser invoice listing the benefits and quantity of items purchased, and a fabricated name and the post office box that an employee uses to collect disbursements from false billings is called A. Accomplice residence. B. Shell company. C. Perpetrator check. D. Cash generator. One reason employees might be hesitant to use P.O. boxes in shell company schemes is that some businesses are specially wary of sending checks to vendors that have street addresses only. A. True. B. False. What is sometimes used to overcome well-designed internal controls of a victim company? A. Shell company. B. Fraudulent invoices. C. Collusion. D. Rubber stamp supervisors. Most of the shell company schemes involve the purchase of goods rather than services. A. True. B. False. A shell company scheme in which actual goods or services are sold to the victim company is known as A. Maintenance scheme. B. Allocation scheme. C. Distribution scheme. D. Pass-through scheme. Thank you for joining this deep dive into the world of fraud detection, ethical practices, and internal controls. As we've seen, fraudulent schemes like bid rigging, shell companies, billing schemes, and conflicts of interest can have devastating effects on organizations if left unchecked. However, by identifying red flags, implementing strong compliance measures, and fostering a culture of integrity, we can effectively combat these unethical practices. Please don't forget your contribution to our channel. Like, subscribe, and if you want, drop a line in the comments.